the last two deals that I got were 4% interest amortized over 30 years with 5-year balloons. Now, a commercial loan, you're not getting amortized at 30 years in the first place. You're definitely not getting 4%, and you have a 5-year balloon anyways. So you can negotiate these things by going off of what makes sense to the person that you're talking to. And I think if you really understand the seller's point of view, you can articulate these and get into deals with less money down, with better financing. And it is a great strategy, especially right now. I mean, and if you can get the seller to finance the down payment, that's the biggest hurdle for most people to get into a deal.
James and Patrick, thank you for joining me for our Thought Leader Spotlight series. I'm your host, Matt Camp over here, head of partnerships at DealMachine. And on these, we really like to shine a spotlight on industry experts like yourself, hear your inspiring stories, and educate our audience on the lessons you've learned over the years. Today, we're really excited to welcome on James Rippeon and Pat McGrath. Patrick, I know you're really a real estate investor turned self-made millionaire, somebody who went from 15 years in the sales profession before making that jump into entrepreneurship. So I know we have a lot of people that can relate to that background and history. And then James, I know you're an attorney that also turned real estate investor as well in property management. So together you guys have 20 plus years experience in real estate investing, and then host the Real FI podcast together. So make sure to check that out. We'll link to that as well. But welcome on, guys. Excited to have you on.
Thanks so much.
Appreciate it. Thank you.
Awesome. Can we kind of start there too of a little bit more about your, investing journey and your kind of journey to financial independence? I'd love to hear kind of how you guys got started, because I know a lot of people listening to this, they're maybe have done a couple deals, or they're trying to do their first deal and are really looking for guidance on how to do that journey themselves.
Yeah, I'll go first because I think Patrick's got a little bit more interesting of a story, so I'll let him dig in a little bit. But I first got started, probably it was 2017 or so. And then I started with doing mailers for vacant land. Like that was the first thing I did out of the gate, looking for vacant land to flip. Didn't buy a single parcel, wasted thousands and thousands of dollars on marketing efforts. I basically didn't know what I was doing. I didn't surround myself with the right people to learn the things I needed to do to follow through. Couple years go by, started getting into purchasing single family properties out of state, North Carolina, specifically High Point, North Carolina. Got up to a portfolio of probably 8 to 10 properties at that point. We did a couple remote flips. We did some wholesale deals. By we, I mean my partners and I, not Patrick. I had some other partners that I was working with. And then since then have just continued to add to my holdings, continue to get involved with real estate one way or another. And all that while that time I was practicing as an attorney. And then since then, just kind of bring full circle, gotten into multifamily. I've got some more properties here in Fayetteville where I currently reside, vacant land, single families. And then also started a property management business after getting more experience with being an investor. Started property management business, got into real estate brokerage services for retail and investors, and have been hitting the ground running ever since.
Awesome, man. And Patrick, you go ahead as well. Love to hear your story too.
Yeah, so I started, we bought our first rental property in 2017, right around the same time. We bought our first home in 2013 as a foreclosure, and we put some money into it over, 2 years, increased the value, and we used a home equity line of credit, a HELOC. We got $45,000 from that, and we used that to buy our first investment property, which was 10 houses down from us. After that, we ended up moving into that first investment property after a year. We worked on it for 9 months. It appraised for over $100,000 more than what we bought it for. So we moved out of our original house into what was supposed to be our first rental property, and we rented out our first house. Then after living there for about 6 months, we decided to move, and we took out a home equity line of credit on that property. And we used that to buy our next primary. And the area that we moved to had a lot of smaller multifamilies. So that same HELOC we used to buy a triplex. So that was our first kind of small multifamily property. With that, we did the Burr method. So we bought it, we renovated it, we refinanced, we got all of our money back. We bought a 4-unit property, and then we bought another single family property. The whole time we're just recycling those same funds from that first home equity line of credit.
Yeah.
Then we got the opportunity to buy a 10 unit for $850,000, and that was in 2020. And what we did is we sold those first 2 properties. So we never actually paid the HELOCs off. What we did is we sold those 2 properties, and we did what's called a 1031 exchange, and we used that as the down payment to buy this 10-unit apartment building. So at that point, that's when I quit my sales job and went all in on renovating that property. And after a year, we refinanced that one. So we bought it for $850,000. It appraised for $1.725 million a little over a year later. And we pulled out $500,000, and we were able to use that to parlay into an off-market 6-unit property, an off-market 7-unit property. So sitting here today, in roughly the last 3.5 years, we've acquired 35 rental units. We have a portfolio worth a little north of $5 million, and we net cash flow right around $15,000 a month. And our specialty now is acquiring those small to mid-range multifamilies, utilizing seller financing and seller carryback, where instead of having the seller finance the whole deal, we try to get them to finance us the down payment. And that way we can use that money that we would have spent on the down payment to then renovate the property. And then we'll refinance out in 2 to 3 years when that note becomes due for that down payment. So that's kind of our little journey and how we got there, and how listeners out there can kind of do the same thing.
Yeah, no kidding, guys. Well, there's a lot to dig in on both sides there. So appreciate you kind of giving us a little bit of background and bio there. I know, you guys regularly do that on your own podcast as well, but I love to hear on our front, speaking to our audience. I'll start with Patrick, just since you, kind of went through your journey there. You used kind of a variety of different, mechanisms and different approaches in terms of how you funded deals like that. The HELOC, that was a really interesting one. Can you maybe run, just for the newbie who is maybe considering a HELOC or is not even necessarily completely aware of how it works, can you kind of break that down even further on exactly how that works? When would it be a good situation? How do you know you're somebody who should be looking into that? How you did that and how you've leveled up from there, like kind of giving us the 101 would be great on that.
Yeah, 100%. So there's 2 different types of ways that you can pull, 3 different types of ways that you can pull out money from your house. Okay, one is a home equity line of credit. One is a home equity loan, and there's a key distinction between those 2, and the other is a cash out refinance. So basically what we did is we used a home equity line of credit. So that's basically like a credit card on your house. The big thing is that you don't pay for any of the money that you get until you actually use it. So if you get $100,000 from your house, it sits there and you don't have to make any monthly payments until you start to pull from that. A home equity loan, which banks also offer, is that same $100,000, they deposit that right into your account, and you have to start paying that back right away, even if you're not using it. So I always recommend the home equity line of credit, because you can use it, pay it back, and use it again. So you have 10 years to use it, 10 years to pay it back. So a lot can happen inside that 10 years. You can utilize that money to purchase multiple properties. And then if your home appreciates, you can actually do a cash out refinance where you can pay that home equity line of credit back, or your other investments can pay for that home equity line of credit back. So there's a big distinction between the home equity loan and the home equity line of credit. And that's what we utilized and what a lot of investors out there can utilize. The key is you have to have equity in your house. So about a year ago, you were able to go almost to 95% loan to value. So if your home was worth $500,000 and you had a good amount of equity in there, you could pull out almost 470. So if you owed 400, you could get 70,000 off of that at 95%. Things are tightening now, so you might only be able to get 80 to 85. But if you're sitting on some equity in your property right now, it's a great way for you to be able to get that down payment and some of that renovation money to go out and buy your first property. And even if you're considering turning your home into a rental, you could go out and buy a small multifamily house hack, and you can only get that 95, plus percent if it's a primary residence. As soon as you try to do an investment property, the max you'll get is about 70 to 75.
Cool. Yeah, I appreciate the distinction there. I mean, we definitely, having being in the nature of a deal machine, interview, we've got a lot of people already trying to find deals, thinking about how to find deals, but the funding side of it is something that I think we can definitely use more knowledge and help understanding, in general. So, appreciate the rundown there. James, on your front, I know, you had focused. You've got like your vacant land. You've got a variety of different things you're focusing on now. Something I was curious, if you were looking at this again, like especially if you're kind of in the newbies bucket, with your variety of experience and different types of deals that you've done, is there a certain space that if you were somebody brand new to this that you'd really focus on in terms of the asset class or it's a vacant land or what have you? Like where would you recommend newbies really think about doing their first deal, and how can they evaluate that in their own market?
So I think about it less as what type of deal to get into, whether it's flipping, vacant land, syndication, multifamily, single family, or any other kind of strategy. Less about that and more about surrounding yourself with the mentors and the people that can educate you and help you and inform you about what to do. I think people can make money doing anything in real estate. Like there's no one thing that works best or least best. There's a margin everywhere to be made. There's a market for everything. But I think that what's more important is that people surround themselves with the knowledge and the mentorship and the people that are really just crushing it, and then gravitate towards that. I mean, I think that when you kind of give people a lot of options, they're going to be chasing shiny objects until they get a couple years down the road and they realize they haven't actually done anything. I'm not going to be here sitting because I've been a victim of that myself. Like I've done that countless times for many years, and I'm still pivoting to this day, like doing different things. And that's a weakness of mine, and that's something that I would educate other people to kind of focus in on. Find focus. Find that one thing that you can do based on knowledge that you can get from others, whether it's somebody that you meet at a meetup, whether it's someone that you're just following on a podcast, whatever strategy, just go deep in it. And, I think there's a lot of opportunity everywhere. People are still flipping. People are buying and flipping vacant land, single families. People are making syndication deals happen, even if it's a little tight with the financing side of things. Like there's always a deal to be made.
Absolutely. That's a great perspective in general. I mean, I think that analysis paralysis stage is something that most people we talk to, what's holding them back from doing that first deal a lot of times is mindset like that and having a lack of focus.
Yeah. And, I was talking with somebody just the other day, and they've been looking to get into real estate for 2 years now. They haven't bought their first deal. They're in their primary residence. And I was trying to pinpoint what the hesitation is with getting into that first deal. And it was the insecurity of not knowing if something was going to go wrong with the property after they purchased it. And I had to tell this individual, something's going to go wrong. I can guarantee it, something's going to go wrong. You're going to get a crappy tenant in there. You're going to inherit a crappy tenant. Hot water heater is going to go. HVAC's going to go. Roof's going to go. Just assume all that stuff is going to happen. But the point of real estate is to dollar cost average into your deals, to do this as a long-term effort, and to not focus in on the small details and forget what the bigger picture is, which is building a portfolio of cash flowing investments. I'm not going to say properties because maybe you're flipping or whatever it is, but you're generating cash flow one way or another. But you don't want to be too focused on the details that you kind of just get lost in the mess. So that's just a little thing for people to be aware of.
Absolutely. Do you see, I know a lot of people, I mean, listening to this might be in that bucket of, they've been thinking about it for a couple of years. They haven't made the jump. Do you guys have any advice, especially coming from, I know, Patrick, you had the sales job, and James, you mentioned you're still, can be a practicing attorney as well, but coming from a professional world and getting into real estate like that, do you have any other advice there of pitfalls that you had to overcome or other mindset shifts that you had to make that transition and finally make that jump?
Yes. I think one of the biggest ones is to, like James said, I can't got to piggyback on this enough, is to surround yourself with people that are doing the things that you want to do. It's going to your local meetup. I know you've heard it millions and millions of times, but if you're having analysis paralysis, go to a local meetup and present your deal to some other investors that are where you want to be, that have two or three properties, and say, hey, would you buy this? Am I not seeing something, you know? And you're going to get the perspective from those people to tell you, hey, your numbers are off here or there, or hey, I think this is a great deal. Or maybe to feel better, you might go to one of those guys and ask to partner, bring them the deal, go in 50-50 on it, and have them show you the way and lead you down that way. I'd rather have 50% of a deal that makes me feel comfortable than 100% of no deal. And that's kind of where James and I get that whole our motto: decide, commit, and take the action. Like, you have to decide that you actually want to do this. You have to commit to it, and then you actually have to take the action. And the only way you're going to continue to learn is by doing something. And you're doing something right now by not doing anything, and you're in the same spot that you were a year ago, 2 years ago. The biggest difference is that you're going to learn from experience, and even if you totally mess up, you're not going to do that again, hopefully, anyways. So that's my biggest takeaway, I think. James, what do you got?
And I'm going to give everybody a very actionable tip that they can do. That's not easy to follow through with. Start a peer group, some sort of mastermind group. Because when I did that years ago, got involved with a group of guys. It started with me and just my best friend who were interested in growing our wealth, becoming better people, this, that, and the other. When I started doing that and incorporating more people selectively into this group, my trajectory in life went parabolic, really. So it was this uncomfortable experience of, selectively, and I'm going to stress selectively, finding those people that share the values that you're trying to obtain and surround yourself with them intentionally. And this might be beyond just the meetup, like the occasional 1 month real estate meetup where you hear somebody talk and you kind of get inspired and now you're just back into the same situation you were next month and you haven't done anything. The point of the peer group is to hold you accountable. Accountability, that's what's key. So that's my biggest suggestion is build that structure of an accountability peer group. Surround yourself with those people intentionally. The way I structured it, we would meet at 6 o'clock at a coffee shop every Wednesday morning. Pain in the ass. You got kids, pain in the ass. You got to get up early if you're a late riser, pain in the ass for sure. But it's worth it. It's going to put you on a new trajectory in life, and you're going to get to where you want to go because you're going to have that weekly check-in. So that's a little tidbit that I'd suggest.
Love that. Yeah, I mean, and love the hat motto as well, right there. Really leading with action. That's what we're telling people as well on our end is hey, being able to approach any situation, you're going to learn by doing rather than being on the sidelines. So absolutely, be able to level up your network and lead with action first. I think across the board is consistently what we hear from people that are in your guys' shoes that have done it. Patrick, one thing I did want to ask on your end. You'd mentioned like seller financing and a variety of these different types of ways to fund deals. Can you maybe talk a little bit more about that approach, especially for the people who, there are a lot of situations out there where it's, we're hearing more and more questions around seller financing, considering, how interest rates have gone, gone the last, 12, 18 months. Can you talk a little bit more about that strategy and how people can fund deals that way as well? And is that something as an earlier stage investor or a newbie, should they be thinking about that approach?
Yeah, so seller financing is actually a great option. The biggest thing is you really have to understand the benefits from the seller and not necessarily the benefit to you. So you want to be targeting properties that the seller either has paid off or has significant amount of equity in there, and that they are going to have a huge tax implication when they sell. So you're looking for older landlords, older properties that are almost paid off. And everyone thinks like if I were to sell or finance a property, okay, it needs to benefit me, but I'm younger. And everybody goes, why would someone give me a 4% interest rate when a bank, if I went to go finance this deal, it would be 8%? Well, guess what? The last two deals that I got were 4% interest, amortized over 30 years with 5-year balloons. Now, a commercial loan, you're not getting amortized at 30 years in the first place. You're definitely not getting 4%, and you have a 5-year balloon anyways. So you can negotiate these things by going off of what makes sense to the person that you're talking to. And I think if you really understand the seller's point of view, you can articulate these and get into deals with less money down, with better financing, and it is a great strategy, especially right now. I mean, and if you can get the seller to finance the down payment, that's the biggest hurdle for most people to get into a deal, especially when you're buying an investment property. It's 15% down for a single family, it's 20 to 25% down for 2+ units. And when you're talking about, a couple $100,000 property or $1 million property, that's a huge amount of money to try to figure out how to get. Well, if this person owes 300,000 on $1 million property, and you ask them to hold the 200,000 for 2 or 3 years, you only have to come up with 50,000 now. Like, you just sliced the amount of money you have to come up with by 80%. You still get in that deal, and you can refinance later because you're buying undervalued properties, under rented properties that you can force appreciation in. So it's only a benefit for that seller who's kind of let their property go and has these low rents to allow you to come in and say, hey, Mr. Seller, Mrs. Seller, the money that I was going to pay you for the down payment, I'm now going to reinvest into your property that you're still going to have a lien on. So if I don't hold up my end of the bargain, the worst that could happen is you now have a property that I just put $100,000 or $200,000 into to increase the rent, so it makes sense to be an investment property. So I think it's a great option right now. I think you have to get out of the mindset on why would someone seller finance this property? Why would someone do that? And just assume that they will. You just have to figure out why for them. It's not why for you, it's why for them. And if you're able to do that, you can structure some really amazing deals right now when everyone else, none of the deals are penciling out because of 7 and 8% interest rates.
And one thing I want to kind of follow up on with Patrick, I'm going to talk about what Patrick does. Maybe he can elaborate on it. He doesn't just send one postcard to a seller. He has a great system for following up and building relationships. And he is focused on a niche market, niche property, niche area. And he knows the people that he wants to buy from. And he'll be pinging them for a long period of time, following up with them to make sure that they're going to be selling to him if they ever do decide to sell in the future. So when you're looking for these opportunities, a lot of it is relationship based. And as Patrick was indicating, you don't want to be in a long-term relationship with somebody that you don't know or trust. So sometimes formulating these seller finance opportunities takes time, over a period of time and multiple touches, just so you can get on the same page with them and convey that you're sincere and genuine and you're going to make a mutually workable deal happen.
Love that. Yeah, that's a great reminder as well. I mean, we're always trying to preach that to people as well in terms of that consistency and having that long-term mindset with your marketing strategy and how you're trying to build a relationship where, hey, yeah, they might not be ready to do a deal now, but maybe 3 months, 6 months, a year down the road, if you're the one that's built that trust over time, then, you're the one that could even present a seller finance option that they would trust. And Patrick, I love your mindset too of like, hey, it's not what you want, it's what it's problem solving for that seller. I mean, I think like a lot of that probably comes back from your sales background, I would think. But do you feel? I mean, I know there's quite a few people on here who might have that 9 to 5 sales job. Like, do you think that prepared you well for for your real estate ventures, or can you kind of talk about how your professional career may or may not have set you up for success in real estate?
Yes. So my sales career definitely set me up for real estate investing, not only for the actual sales experience, because let's face it, every single person is in sales every single day of their life, whether they like it or not. Okay. So you are in sales. So you have to take that and utilize that to the best of your abilities, especially when you're trying to do off-market deals or you're trying to sell yourself to that seller. So that helped me out a ton. And the biggest thing is the follow-up. You have to follow up, and it has to be genuine, like you were talking about. Each one of these off-market deals has taken me over a year from that initial contact to actually closing the deal. Okay, because people buy from people they like and trust. People sell to people that they like and trust, especially when you're trying to do some creative financing. And like James said, it's all about trust. You are entering into a multi-year relationship with this person. Okay, so they have to trust you. And you are asking them to put a lot of faith in you by giving you a couple $100,000 loan that you need to be able to repay. So it is building that trust. I think sales is one of the best professions to help propel you into your real estate career, because the beautiful thing about sales is the harder you work, the more deals you close, the more money you make. Okay. So with that, you can use those commissions to then save up for those down payments a lot easier. And that's the biggest thing about deal flow with real estate is you have to close deals. That's what we're all trying to do, right? We have to close deals. So you need to learn closing strategies. You need to have the ability to be determined to follow up. You need to have those systems in place. So I highly recommend, anyone out there that's in sales, you are going to have an edge over everyone else that doesn't have any sales experience or just doesn't have that relentless ability to overcome objection. Because look, you are going to hear no 99% of the time. That's going to be the answer. No, your offer's too low. I'm talking with somebody else. I'm not interested in selling. Call me in 6 months, whatever. That's the average, okay? 99% of the time. But you only need one person to say yes to get an amazing deal that's going to set you up for the rest of your life. So by having that sales mentality, you can navigate through all those no's to get to that yes that's going to give you an incredible deal. So yes, sales does help you out extremely when it comes to real estate investing. And I think anyone that is looking for a career change, now's the perfect time. Like if you want to make some more money, to go out and get a sales job, if real estate investing is what you want your future to be, because it's only going to set yourself up, and you can have someone actually pay you to get the skills that are going to help you down the road.
Love that mindset. Awesome. I did want to wrap up here on James, on your end. One thing that we touched on at the beginning of this interview as well, talking about property management for the more advanced investor who is building that portfolio. Can you maybe talk through, like, hey, should I hire a property manager? Should I start my own thing? Like, what tips and pitfalls have you learned over the years? Like, maybe if you give us a little bit of a crash course on the property management side for a few minutes, that would be fantastic. If you could.
For sure. So I started off, buying those single families and then having third party management in place, principally because I was out of state. Um, that just was a convenient thing to do. That's what I read on Bigger Pockets and elsewhere, that, you want to have good, solid property management in place. The process that I went through to find that property manager, I literally just worked with the manager that was managing the properties before I bought them. And it worked out fabulously after that. I've heard some horror stories with property management. Of course, property manager is not going to care about your property like you do. You're just going to have to understand that fact from the beginning. So they're not going to be checking in on the property as much as you might if you're going to be self-managing, and they might not be as judicious with making sure that the repairs are under a certain threshold for the bills. So, those are some cost benefits with it. I think when it comes to self-management, because I do manage some of my own properties as well, it's totally possible. It's not very complicated. At the end of the day, it makes you a better investor. And then if you, like, for example, right now, it's a tough market to get into real estate. Like, interest rates are going through the roof, cash flow is squeezed. This is an extra 10% you can make per month if you want to take on this effort to learn. If you're looking to get into investing, buy locally, buy something that's going to pretty much be close to breaking even at least, and then add that 10% to your income by managing it yourself. It's not a very super complicated process to manage a property. It's very simple. You find a tenant, put the tenant in there, collect the rent, and you deal with issues as they come up. There's going to be a lot that you don't know as you get into it. You're not going to know the contractors right away, but those are the relationships you form as you build your business. Patrick does a great job self-managing his units currently. Like that's his job. He's collecting that rental income for himself. He's not paying a third party. And what that has set him up to do potential in the future is maybe start a property management business, building out this hub and spoke real estate empire that he's working on between the acquisitions, the developments, and then the property management. It opens up opportunities for you. So, there's nothing really wrong with trying to learn something new, make a little bit more money if the margins are tight, but you got to look at it from the other side as well. Do you want to work on your business or in your business? So, that's kind of the countervailing thought. Like, do you want to own 10,000 units, or do you want to own a small but mighty portfolio of 10 owned outright properties that you manage yourself? So, really, it comes down to your goals, assessing like where you're trying to go with your real estate portfolio, and then how you want to manage it. Personally, I like doing manual labor as an attorney, real estate broker, property manager. Like, I love cutting grass. I love making repairs at the house. I love doing remodel projects because I just get some fulfillment from that. Some people just hate it. And they just never want to touch a hammer. That's totally fine as well. But you just got to orient your portfolio and your real estate goals to your personality and what you want to get out of it. So that's what I would tell to somebody who's kind of thinking whether they want to self-manage or hire a third-party manager.
Yeah. Patrick, do you have any advice on going the self-management route? Anything that you'd recommend for people?
Yes. One of the major things I would recommend is in the beginning, make sure that you utilize some form of digital payment system. Make sure to actually do a credit check, background check on every single person. Call their references, call the landlord that they put down. Really check on all of that. And look, you're gonna make some mistakes, but it's really not that hard. Okay, we have, like I said, built a portfolio of 35 units. If I were to hire a property management company, it's gonna cost me somewhere between $5,000 and $6,000 a month that's being taken away from me, and I'm not getting $5,000 or $6,000 a month worth of headache calls every month. It's really not that hard. The most time consuming part is actually placing the tenant, not necessarily finding the tenant. It's just that time of having to go and show the property and answer the listing ads and all of that part. Outside of that, once they're in, if you are renting high quality, safe, places, it's going to be easy to fill. And once they're in, if you took care of all of the necessary things before you place the tenant in there, you're really not going to have very many issues. I'm not getting calls. I've never got a call at 2 a.m. for a toilet or something like that, right? It's not you. The bad stories are amplified more than the 95% of the things that never go wrong. So I would just recommend. And how are you going to be able to know if a property manager is doing a good job or a bad job if you've never managed a property yourself? You have to have that experience to then know, okay, this is eating up a lot of my time. I hate this. The 10% now looks like a great deal to me to get rid of that headache. Otherwise, you've got no gauge on it, and you might actually enjoy it, like James. You might actually enjoy it like me. You get to manage your assets. This is what hopefully is going to help you become financially free and financially independent. And you need to have your pulse. You need to have your gauge on that on a regular basis to make sure that your assets are being managed the best that they possibly can. So gain that experience by managing one or two properties. If you absolutely hate it, do a property management company. But you can manage a portfolio of 50 to 100 units by yourself, not taking up that much time, and you'll get the systems in place as you need to get the systems in place. Like, don't try to put the cart before the horse. Like, just decide, commit, take the action, start doing. And as problems happen, you'll end up putting those systems in place to alleviate those problems.
And if you do choose to self-manage, as Patrick was speaking, I kind of had this pop in my head, thinking about the type of tenant you want to get in there and what it costs to turn over a tenant. I think it's important to kind of realize that you're looking at it from a couple different angles. You want a long-term person that's going to help minimize turnover costs in the future. So a lot of people will, when they self-manage, they're trying to set sky-high rental rates and like breaking records for the neighborhood. But what that might bring you are tenants that may be less qualified to rent a place, and then perhaps also more transient tenants as well. What that does in the long term is it causes more turnover, which is the expensive part of owning a property. So, my advice is always to be careful with setting your rental rate so that you get somebody in there that's going to stay long term, because you're going to be able to do rent increases in the future. But what we want to do is minimize vacancy and turnover. So it's not always about the high rents. Sometimes it's a bigger picture analysis. So that's another tip I'd throw out there.
Yeah. This has been awesome, guys. I really, really appreciate your perspective on it. And I think you guys just make it so approachable in terms of how to take action, get into this. And I know I came away inspired, being able to hopefully have a lot of people listening to this find real estate a little bit more approachable to really be taking action. So I really appreciate your guys' time today. Can you maybe tell people how to connect with you directly? I know you guys have a podcast of your own. What's the best way to connect with you guys?
So you can reach me on Instagram at James Rippeon. And then most importantly, follow our podcast, man. We're looking for some new listeners to add to our ranks and inspire and motivate to become financially free. So Instagram or the Real FI podcast.
And my Instagram handle is at Rental Property Couple. It's myself and my wife. We show everything. So if you want to go recheck on the numbers and go back all the way to that first property, we've got everything on there. And again, you can check out our Instagram page or our YouTube page for the podcast at the Real FI podcast. So thank you so much for having us on. We really, really appreciate it. And I hope some of you guys out there are now motivated, a little more educated, and 100% inspired to go out there and crush your dreams.
Perfect, guys. Yeah, so I'll go through. We'll make sure we'll link to all that below. We've got a few resources on our end we'll link to as well. But again, James, Patrick, thanks for both coming on today, guys. Appreciate your perspective and your time here.
Absolutely, Matt. Appreciate it.
Thank you so much, Matt.
Yeah, so to everyone watching, this is Matt Camp over here with DealMachine, and happy deal finding.